We just learned about three types of negative downward markets. What I want to say before we get into predicting these markets, which is something we're to do at the end of the course. So next we're going to talk about preparing for these markets, but we're going to prepare for these markets under the assumption that we cannot predict any of these happenings, any of the corrections, crashes, or bear markets that are coming to us. We're going to use that assumption. Now that's not entirely true. Many people are actually quite well known for predicting the 2008 crash, for example. And later I'm going to show you some methods to look at predicting bear markets and market crashes. But overall, we can't predict corrections, bear markets, and crashes with good accuracy. And I'll tell you why in a second. But I'll tell you why by addressing each of them in turn. So a market correction, as we discussed previously, happens because of the psychology of traders. People see the stock market going down after a long bear market. They get a little scared that the market's going to crash and they kind of pull back. They are afraid of losing what they've already gained, so they pull back. Other investors see them pull back, so they pull back as well. And it's just it's a snowball effect until we reach a point where investors realize there's really no reason to be pulling back. It's time to buy these undervalued stocks, and the stock market goes back up again to continue the the bull market. You can't really predict that happening because we don't know when people are going to freak out. We don't have a good enough grasp on overall sentiment of the stock market for all of the investors. That's including institutional investors, individual investors, people who are investing in the stock market for retirement and all that kind of stuff. You have a group of risky investors, a group of conservative investors. Putting all their psychologies together doesn't really give us a single accurate depiction of when a correction is going to happen, which is sad, but that's what makes the stock market kind of fun. So we can't really predict a correction other than knowing that it's going to happen once or twice, or usually 2 to 3 times per year, and preparing for it's better than predicting it. Now for a bear market, it's actually easier to predict a bear market because a bear market is the product of a poor economy, sometimes, but it's also a product of a stock market crash other times. And if it's the latter situation, we won't be able to predict it unless we also predicted the stock market crash. And we can't really predict a stock market crash because they are black swan events that usually occur from some strange situation, such as the mortgage problem in 2008. What I'm predicting to be a stock market crash in the future in Canada is probably due to bank rates being lowered suddenly, which is not something we could have predicted. So all of these rare events, they don't happen with forewarning. And because of that, it's much better to prepare with the assumption that a correction or bear market is going to come, rather than wait to see a sign for that market and then tweak your portfolio to prepare. It's better to always be prepared. So even if you don't want to be like a 50-50 long-short investor, at least have some percentage of your portfolio in hedging or in speculating that the market's going to crash, so if it does, you don't lose everything. That's what this entire course is about. So this lecture is just on the idea of not being able to time the market. Don't expect that you can predict anything other than like a bear market that we saw in 2000, where the economy just kind of slumped. Everything else is pretty unpredictable, and it's just a waste of time to dig into things looking for answers as to when a market correction or a market crash is going to occur. Just assume it's going to occur sometime in your lifetime, sometime in your trading career, and prepare for it. If you're prepared for it, things are going to work out okay.